Good day, guys. I hope you're well. Today's tutorial is on individuals and travel allowances, essentially, right? So a bit of employee benefits. And yeah, I had recorded in class in the last tutorial, but I lost that recording because it doesn't have sound. So yeah, I'm forced to re-record again, but I think it's for your benefit, guys, because at least now I'm not in the rush of, well, I won't make it long, but at least I can explain my some things more thorough than I would in class, because when we're doing it in class there's time pressure because you want to finish within like a 50-minute window, so that by the time the next person or the next lecturer comes, you are done, you've covered the question. Okay, so like I always say, please when you do a question, take note of that. That's very important. You are gunning for 30 marks and you must do that to get the 30 marks, or as many marks as possible in 60 minutes. Once the 60 minutes is done, move on to the next question. And another thing is, now this is the last tutorial before test 4. You guys are going to write. Please don't show up at the venue without having done any questions. You are killing yourself, you know. Essentially all lecturers can do is give you theory in class, you know, and it's your duty now to go and sit to your place and apply that theory by doing questions. And then when you're doing questions, it's very important that you essentially recreate the exam environment. You know, you don't want to do a 60-minute question in 4 hours, even if that means you get all 30 marks. It means nothing, you know, because in the exam you'll only have 60 minutes, and honestly, it doesn't make, once you've done the question, mark yourself honestly. Don't be too lenient on yourself, and whichever mark you lose will be either one of 3 things, in my opinion. Maybe there's a 4th one, but I think the most common 3 would be you don't know the theory, you don't know what was being asked in the question, meaning you must go back to your slides and you must go back to your silk and educate yourself on the theory, like about whatever thing you lost marks on. If you know it but you still didn't get a mark on it, you still got it wrong, then it's probably how it was asked in the question. So that's why you lost the mark. You lost the mark because you couldn't understand like how it was asked in the question. Then number 3, you can lose a mark because you're too slow, you know, and that's you are slow. You know the things, you know your theory, you know how it's applied on questions, you understand how it was asked in the question, but for some reason you couldn't get to it within the 60-minute window. Then you're probably too slow. Then that means you should try and be faster. So these 2 mostly exam technique, and the one is just like obviously knowing your theory, you know. And the more you practice, the faster you get, and the faster you're familiar with the language used by examiners, you know. So yeah, that would be, I guess, my advice. But after you've noted that, when I come and give yourself purpose, in this question you are asked to calculate the tax payable or receivable by Vogile Jola for his 2023 year of assessment. So I highlight that, and they tell us show any considerations or limitations could be applicable. So escape considerations where limitations are applicable. Then for B, it says, as mentioned in bullet point number 5 above, so this is relevant to bullet point 5 above, Fueller's parents belong to a medical aid fund. Although his father retired due to old age, his former employer still makes contributions to his medical aid fund. So father retired, but former employer still makes contributions. Vugile would like to know the effect of this contribution. So what is the effect of this contributions made by the former employer on his father's taxable income, based on an extract from the Income Tax Act as provided below? Advise Vugile on this matter. Yeah, guys, I won't do this. Please do this, because essentially the whole purpose of this is that you are tested on your understanding or your ability to comprehend legislation and apply it on like, say, a case study. Essentially legislation you've not been taught before. So yeah, this is your room right here. What we'll do together is A, right, where we calculate the tax payable or receivable, and we give considerations for any limitations. So we're dealing with Vugile Jola, as we've noted, and then we're told here he's 38 years old. So 38 years old, and I think, okay, primary rebate, 23,800 rands for interest exemption, for 6 cap A or 6 cap B might be more lenient or leaning towards 6 cap B because he's younger than 65, and if he's not disabled, the wife is not disabled, his child is not disabled, then you'd apply 6 cap B, the 25. When you're applying 6 cap B, you apply the 25% method, not the 33.3% method. Yeah, he's a resident, then will be taxed on worldwide income or receipts, right, rather than receipts only from a source within South Africa. Very important to note, he is married in community of property, right? So this means now for trade income 100% nothing changes, but for non-trade income, trade income in the form of dividends, interest, rental of fixed property, rental income from fixed property, the renting of movable property is considered a trade, so that you include 100%, but the renting of fixed property, the rental income therefrom, is considered non-trade income, and you'd have to divide by 2. So he is married in community of property to Popijola. In this case, okay, that's the spouse. That is his spouse. They have an 8-year-old son, so another dependent of his, it's his son, and obviously this should mean to you, because that's his child, but this should also mean something to you. He's 8 years old. When you tell you there that he's 8 years old, you must write maybe that now there's a minor child in this scenario. You might want to take note of that the son is a minor child, and he's he's not married, so he's a minor. He's still a child since he's not married, because he's younger than 18, and as long as he's unmarried, he's still considered to be a child. Vukile is employed by Medicine Equip Limited, so that's the employer. He's an employee. Vukile is employed by M-Equip as a medical sales representative. M-Equip specializes in the sale of medical equipment to hospitals and private doctors. The following information relates to the 2023 year of assessment. Again, it's pay required. You want to compute his normal tax payable or receivable for 2023, for the 2023 year of assessment, and then you're told the information now you're about to read. That's where essentially your marks should come from, because it's related to the 2023 year of assessment. So I told Vukile received a salary of 240,000 rands for the year. What that means is do not multiply by any months, because it's an annual amount. And remember, we pay tax, or we essentially account for our normal tax annually. So it means do nothing, take it as is. He also received commission of 96,000 rands, which was calculated based on 2% of gross sales of all medical equipment he sold during the year. So quickly, we're gonna do it the same way we do it in class. You read a line item or a note, then quickly discuss and do its tax implications. But for individuals, it'll be tricky, because you must now know when to do or account for certain item and when not to, based on your framework. But it should be easy. This is gross income, right? Salary 240,000 rands. At this point in time, you should not rush to have something here. Let me just highlight it, because you only need the remuneration column if the taxpayer, Vukile in our case, made contributions towards retirement. However, one thing you might want to note here now is you have his remuneration, and his remuneration has a commission element to it. So based on individuals, remember we discussed section 23M, and we said for 23M, people who fall outside 23M are employees whose remuneration is mainly derived from commission, right? So you want to check, okay, is he within or outside, because it will affect a lot of things that you do with regards to the taxpayer. So you quickly do that to say 96 plus 240. Then you see there that it's the commission he earns in terms of his total remuneration is only 29%, meaning it is not mainly derived from commission. Therefore 23M right together with B and every other section is applicable, right? So meaning he's limited in terms of what he can deduct, right? Okay, But in this case, again, remember, you do not need to be thinking about remuneration because you don't know. Like as we're doing the question, I'm assuming this is the first time you're reading the question and you're not thinking about writing at this point, but you just want to understand what's happening in the scenario in order to decide whether should you do the question now or should you maybe do question 4 instead of 2 first because you find 4 easier, right? So this is like basically going through your thought or what ought to be, at least your thought process at the very least. Okay, we're told as Equip specializes in the sale of medical equipment, Fuller often travels to clients. Travel to client, that means he travels for business purposes, using his own car. Again, very important, own car, because now it affects how you'll do your travel allowance if he gets any. To facilitate this process, Fuller received a travel allowance. So now you know, okay, he got a travel allowance of 5,000 rands per month. Whenever you see this right here, whenever you see that travel allowance, you want, first thing you should think of is what type of travel allowance, because it affects how you do it. Is it fixed or is it reimbursive? Right, is it a fixed travel allowance or is it a reimbursive travel allowance? In this case, we are dealing with a fixed travel allowance. Why is it fixed? Because Vukile, respective of the kilometers he travels in one particular month, he gets a fixed amount of money of 5,000 rands per month. For a reimbursive travel allowance, typical question would go like, okay, he traveled like, as Equip specializes in the sale of medical equipment, Vukile often travels to clients using his own car. To facilitate this process, Vukile is paid by his employer a rate of 20 rands per business kilometer traveled. Give you a rate and we tell you he essentially gets reimbursed for each business kilometer he travels. So meaning he must first travel, go to his employer with a logbook and say, okay, this month I traveled this many kilometers for business, and then he can claim that. To cover the necessary costs during the current year of assessment. And then obviously, if it's a fixed travel allowance and he has an accurate logbook, then he can claim deemed costs, right? And if he has accurate records as well to support his actual costs, he can claim actual costs as well, but he'll choose the higher between the two, obviously. If it's only a reimbursable travel allowance, it's deemed costs, actual costs, plus the simplified method rate of 14 rand and 18 cents. You have to know that one. Okay. So we'll tell you he purchases Toyota Fortuner second hand on 1 November 2020 for 489,900 rands. This is inclusive of VAT of 39,000 rands and finance charges of 29,900 rands. Okay, I will discuss this point now. But yeah, keep that at the back of your mind. But if you had seen the first version of the question, you know that was 48,000. Oh wait, yeah. Oh, this is okay. Cool. Yeah. No, I haven't changed it. That's good. Okay, yeah, we'll discuss this. In total, he travels 20,000 kilometers during the 2023 year of assessment. You wanna take note of that as well. So, the total kilometers traveled are 20,000 kilometers. Wheeler kept accurate records. This is very important, of all expenses. Since he kept accurate records of all expenses, what this means is this: if he is selected for audit, and so says, okay, we see that you claimed based on your actual rate of this much, we want to see, give us the supporting documents that support the calculation of the actual rate which you used to claim or reduce the travel allowance you received, right, the business component thereof. And then he'll have to produce, for example, bank statements that show the installments he's paying. He'll have to produce fuel receipts, insurance, maintenance, and license cost receipts, those kind of things. So it's very important that he must have the accurate records to prove that. And since he has them, then it means he can claim them. With SARS, most often it's not what you it's what you can prove. Let's just say it that way. It's what you can prove. It's not enough to just say, no, but I paid. No, can you prove it? And if you don't keep records, then you cannot prove it. He incurred the full cost. That's also a very, very, very important statement, because it means now in terms of your deemed cost table, If he incurs the full cost for maintenance and he incurs the full cost for fuel, then you include those rates there, right? However, if these rates, let's go down. Don't want to make this too long. These rates. So for this one, you have to. That's right here. You have to, for fuel and maintenance. Okay, let me just reduce it. Maybe change the color to make it red because it doesn't blend in. For fuel and maintenance must incur full cost. Otherwise, you include zero if it's not the full cost. Right? Okay, something is wrong there. But yeah, you get the point. For fuel and maintenance. So for fuel and the maintenance there. So that's why it's important to know, was he incurring the full cost? Meaning, if he incurred the full cost for fuel, you include that rate, the dim rate. But if he didn't incur the full cost for maintenance, then you include zero in the place of maintenance of the following expenses relating to his vehicle. And we told you that he paid installments, and so 90,000 for the year. But this amount includes finance cost of 48,000 rands. Yeah, remember I said we'll discuss this point. The way this question is structured is wrong. Why? Because I don't know, even there's a student who asked this question, a very, very important question, and also for me never felt comfortable. Like why would you have financed costs at time zero? Like, before you even get into purchase or get into the agreement to purchase this car, you've already incurred costs. Like, when you're buying the car, you're paying VAT plus a portion of interest, but this is T0, like transaction date. Didn't make sense. But so what I'm getting to is this interest component here will give you here, right? This interest component will give you here. First of all, we give you this information, the 89,900 rands inclusive of VAT. It relates to the cost of the taxpayer, the cost of the car to the taxpayer, right? So the cost of the car, we tell you here, is 489,900 rands. But in this 489,900 rands, there is VAT of 39,000. Maybe not that, right? Okay. So in this, VAT is 39,000 rands, right? So meaning the cost of the car exclusive of VAT would be 50,900, right? Correct me on the math if I'm wrong, but yeah, I think. But now we tell you that this cost of 489 as well, it wouldn't be that. It would actually be less than 29,900, which would be in this case 421,000. And then there's the fee charges as it is written currently of 39,000. Then if you know your FPS, you might ask yourself, but there hasn't been any passage of time yet. What are these costs? Are these loan processing costs, or like banking costs? What are these finance charges? Is this interest for the passage of time, even though there is no time which has passed? And the answer is these finance charges. Well, it's not 29. These finance charges of 29,900 rands are the cost. Like, for example, when this person is buying this car, they'll go to a bank, right, and say, bank, I want to buy a car that is 450. Is it 489? So there should be 460,000 rands. The 39,000 plus 421. The car is worth 460,000 rands, right? Okay. And then the bank will say, okay, we'll loan you the 460,000 rands for a 5-year period on maybe, let's pretend it's a fixed rate, but it's usually a variable rate. But your total finance charges, in other words, if we give you 460,000 rands over the 5-year period, you'll pay us interest of 29,000 900 rands. That's what that means. So this is the interest, the total. If you do your amortization table and you calculate the interest component for each interest payment, and then you add them up over that 5-year period, you get to this number of 29,100 rands. Meaning it doesn't make sense now, where if his total interest or the expected interest, the interest is expected to pay over the 5-year period, doesn't make sense when it's less than the interest incurred in one period. Like for example, here we tell you that during 2023, his interest expense was 48,000 rands, but when he entered into this car, his interest payment, or the maximum he was gonna pay for interest over the 5-year period, over the debt period, is 29,100 rands. Then why is it more than, doesn't make sense. So it has to be essentially be the other way around. This number should be the bigger one. This should be the 48,000. Then in a year of assessment, over, meaning the 48,000, he borrowed 460,000, and the usury on the 460,000 over the time period of the loan is usury being interest, guys, is 48,000. And then in a year of assessment, it would make sense now when it's 29,900 rands, for an example. So we'll do that. But yeah, at least you now know where it's coming from. So we'll do it like that now. We'll make this the 29,000 into the 48,000. And then we'll make this the 29,900, right? So that it makes sense. And I think the paper, I've already uploaded the question on ClickUp. I think it's this way, right? Okay. Fuel costs of 29,000 rands, insurance, maintenance, and license costs of 25,300 rands. And then we tell you Vukile also kept an accurate logbook. So he kept an accurate logbook. Very important statement. Now this means he's in a position to claim deemed actual, both deemed and actual costs. But it also means he can claim deemed. Without an accurate logbook, you cannot claim the business component of the travel allowance. Why can't you? Because remember, you will say total allowance received minus the business use thereof, meaning that if he didn't keep accurate records, then they would only be made up of the deemed rate per kilometer. But that deemed rate will get the deemed rate multiplied by business kilometers, and since you don't have an accurate logbook, what are going to be your business kilometers? So that's why I say you cannot claim you cannot deduct the business component of the travel allowance unless you kept an accurate logbook. Indicating that, so he traveled 5,000 kilometers to clients. When we put it to you like that, it means these are business kilometers. Okay, already there. These are business kilometers. Maybe let me go back to the blue. Yeah, blue is better. These are business kilometers. That's what that statement uses. So the total kilometers are 20,000 and the business kilometers are 5,000 during the 2023 year of assessment. So let's quickly deal with that. Okay, maybe I'll just put exempt income here. Yeah, guys, remember this is a travel allowance. It's not a fringe benefit, so it doesn't go under gross income. If you're asking why now am I this was a travel allowance. Okay, so first things first, what you want to do is you want to get the easiest marks. So the first step you want to do is you want to calculate the allowance received. Easy peasy, guys. We tell you he got 5,000 rands for 12 months. So meaning he received 60,000 rands, right? That's how much he received. Then from this now, you want to say, okay, remember your strategy. When you are writing a test, it's like you are playing what is running, like doing a treasure hunt of some sort, and there's no one treasure. It's not the end of the rainbow. The treasure is scattered all over the place, and you must collect it in bits and bits. And if that's the objective, then it means you must try and get the easy things first, before you go and do the hard things. The easiest one, like I'm saying, calculate the allowance received. Then but we don't know at this case if we'll need to calculate remuneration. But for the sake of explaining the travel allowance, if you need to calculate remuneration, then it becomes easy now. You just ask yourself, that's the second easy mark, to calculate the remuneration component of the travel allowance. And it's either 80% or 20% of the travel allowance, depending on how much the travel allowance was used for business. So in this case, we're told he traveled 5,000 kilometers for business, and in total for the year he traveled 20,000 kilometers. So it means he used essentially the travel allowance for 25% of the time for business. The other 75% was for personal use, right? Because 5,000 over 20,000 times 100, that's 25%, right? And then the Act says, or Silk says, rather from your perspective, that if the taxpayer used the travel allowance for at least 80% for business, at least 80% for business would be a scenario where it's 60,000 kilometers that he traveled for business. Okay, I think I actually wrote that down. If he traveled 16,000 kilometers, let me just, for business, then it would be 80%, right? So it would be 80%. If this would be the case, for remuneration, we would include only 20% of the allowance. That's 20% of 60,000, right? However, we told you that he only traveled 5,000 kilometers for business, so meaning only 25% of the allowance was used for business. And since this is the case, meaning it's not at least 80%, it means then the Act says include 80% of the travel allowance received. So we'll include 48,000 rands. But remember, again, you will only need this column when we tell you that the employee made contributions towards retirement. Okay. So 25%. Okay, trying to write it down. Okay, cool. So easy mark. What did you receive? Another one is, okay, if you are supposed to calculate remuneration, ask yourself, what portion of the allowance was used for business? If it's at least 80%, include 20% of what you've just calculated as remuneration. If it's less than 80%, include 80% of what you've just calculated as remuneration. Then move on to maybe a little bit tricky part. Calculate the deemed cost rate, right? And we tell you that for deemed costs, I'm going to just align it. For deemed costs, you must have an accurate logbook. That's the bare minimum you must have. But then in order to do that, we must first calculate the value of the vehicle, right? Because we need to know where does it fall on the table. So the value of the vehicle will be the 489,900 rands minus, remember we changed it now from 29,900 rands to 48,000, right? So let's 48,000. That's the value of the car. So that would be 489,900 minus 28. 461,900 rands. That's the value of the car. I think my maths was wrong. Maybe I'm right. I don't know. It's fine though. So the car is worth 461,900 rands, and then now you know. Okay, I need to do my fixed cost element. In terms of your fixed cost element, you ask yourself, where am I on that scale, on that table? Come here, say, okay, my car is 461,900 rands, and you will note there that 461,900 falls here, right? 461,900 is between 380,000 and 475,000. So the fixed cost element is 116,438, right? So it's 116,438. Then a side note on this is this, guys, you apportion this amount using days if the employee didn't get a travel allowance for the whole year of assessment. In this case, he got the travel allowance for like the whole period, the whole year of assessment. So there's no need for us to apportion. If, for example, he got it for 5 months, then then you would say essentially times, let's say the 5 months was from April, 30 days for April, 31 days for May, 30 days for June, 31 for July, 31 for August. Then you divide that by 365 days and that would give you your answer, right? But that's not what we're doing right now. Okay. In other words, we don't need to apportion it because they got it for the whole year of assessment. But what we need to do now is just essentially divide the fixed cost element by the total kilometers he traveled, which is 20,000, and that gives us a rate of 5.822 rands per kilometer. Then, since he incurred the full cost for maintenance and fuel, we take the fuel, the deemed rate for fuel, which is 183.8 cents, guys. Very important to note, these are cents per kilometer for fuel. Okay, I don't know, it's not doing what I wanted to do for fuel, and that's cents per kilometer, right? Cents per kilometer. So and here our calculation is in rands. That's 5.822 rands. So meaning we have a duty. Maybe let me do it this way and just write this like this. Right, you have a duty to convert the cents into rands, and you do that by, it's 183.8, I think. 183.8 divided by 100, meaning 183.8 cents divided by 100 cents to get into rands, and that give you 1,838, right? Keep it simple. Maintenance, and that's 72.3 cents. So, and you want to move now from cents to rands by dividing it by 100 cents, and then now this gives you your deemed rate per kilometer, and that's 3.83 rands per kilometer, right? And since he has receipts that prove the actual costs he incurred, you want to know what is the actual rate per kilometer that he incurred. So if I start with the easy one, wear and tear. If he was leasing the car, this is where you'd essentially, because it doesn't incur the wear and tear. You cannot incur the wear and tear of something you don't own. The owner only can incur the wear and tear. If you are leasing it, you incur leasing or renting costs. So this is where you add your renting costs. So in our case, it's 461,900 rands divided by 7 years. So that would give us what? 461,900 over 7. 65,986, and then you quickly then add your other costs. So we had finance charges that incurred, fuel, okay, maintenance, etc. Right. Then just let me go get. But remember, for fuel we swapped it around, so it's now 29,900 rands based on the explanation I gave prior. So for finance charges, 29,900. For your fuel, things 29,000, and then for this one, 25,300 rands. And then I just wanna do that, sum them up. That gives us a total for actual costs of 150,186 rands, right? And then you just divide this by the total business kilometers, because you want the actual rate per kilometer, and the actual rate per kilometer is 7 rands and 51 cents essentially. And then remember, now you must choose the highest between the deemed and actual cost. You must choose the highest between your deemed rate and your actual cost. And in this case, obviously the deemed rate is our actual cost. Why do you need to do so? Because remember, he received 60,000 rands, right? That's the total he received. And then the 60,000 rands was used 2 ways. It was used to travel for business, and he said he traveled 5,000 Ks for business. And then he also traveled for personal purposes, the other 15K, meaning in total traveled 20,000 K. So 25% of the allowance, deem it to be used for business purposes, and the other 75 for personal purposes. And then us, what we want to tax, essentially, we want to tax the personal use of this allowance, right, by deducting therefrom the business use. And we say to do so, calculate your deemed cost rate per kilometer and your actual rate per kilometer, right? And once you have done that, you choose the highest between the two, so that essentially the employee can deduct the highest, they can have a higher deduction. So the business use is 8.383 multiplied by 5,000 kilometers. That's the business use, right? So that is 41,915 rands. We do that. And then, so meaning, what's the personal use now? Meaning the personal use of this allowance is 60,000 minus the 41915. That's the personal use, and that's what we want to essentially deduct or essentially tax. So in this case, it would be 60,000 less the business use of it. That's leaving us with the personal use that we want to tax, right? So 18,085 rands, and that's a travel allowance, guys. It's not that difficult, but yeah, obviously you have to climb a hill before it gets easier. And then moving on, during the previous year of assessment, during the previous year of assessment, Vugile bought a rental property. So rental property in Midrand. He rents out this property to a non-relative. Essentially, we're saying accept the rental as a market rate. You don't have to choose. It's not rented to a connected person, so he doesn't have to charge maybe a price that is not a fair price, or that's not a market-related price. And receive rental income. So this is rental income, passive income. Why? He's leasing fixed property of 48,000 rands in the current year of assessment. He also incurred tax deductible expenses. Guys, when we tell you there that it's tax deductible expenses, what we mean to tell you there is that don't argue, just deduct it. It's deductible for taxation purposes, right? Of 30,000 rands related to this property. So easy peasy. But what might make this difficult now is that you remember this is non-trade income. When you say dividends, rent income, or interest income, or royalties, maybe you must remember it's non-trade income. And then we said if our taxpayer, like we noted here, said our taxpayer is married in community of property, therefore you need to divide both the income and the expense from the property by 2. So quickly do that. Rental income, the calculation would be 48,000 divided by 2, and you include the 24,000 rands there. And for your deduction, you can say rent. Well, it's not rent expense. Let's just say expenditure. Let's call it expenditure. It's the 30,000 divided by 2 plus each spouse includes half. Okay, I don't want you to do that. I want to show the calculation. Divided by 2. And then you include the 15. Well, but remember this is a deduction, so you need to deduct that. Okay, cool. Move on. Vukile is a member of Explorer Medical Aid Fund. So here you want to be thinking 6 cap A, 6 cap B. In other words, medical tax credits, but only if you meet contributions. 6 cap A and 6 cap B. Once you've applied 6 cap A, you need to apply 6 cap B. The only time you want to apply 6 cap A is when the taxpayer didn't make contributions towards a medical aid fund and only incurred qualifying medical expenses. That's the only time you just do 6 cap B. Let me tell you here that both his wife and son are dependents. Wife is a spouse. Paragraph A of the definition of dependent. For B, son is child, minor child. So paragraph B, dependence on his medical aid. During the current year, he contributed. That's your trigger now. Now you know, okay, most definitely I need to do 6 cap A and 6 cap B because he contributed 37,000 rands to the medical aid fund, and M-Equip contributed 37,000 rands as well. So M-Equip contributed. Now you know you are dealing with a fringe benefit, right, that you must include in gross income. So you quickly do that. Okay, I don't know why it keeps doing that. M-Equip medical aid 37, they contributed, so that's a fringe benefit. Paragraph I of gross income. And then for now you park it. So you are done. Essentially you are done with this transaction. You are done with this transaction and you are done with this transaction, but you are not done with this transaction. Why? Because you still have to do a 6 cap A and 6 cap B, but at least you've only accounted for the fringe benefit component therein. Really responsible for the care and support of his elderly parents. Remember now, when we're talking about care support, when we're talking about family members, that's paragraph C of definition of spouse, of dependent, right? So meaning his parents are dependent on Vukile. They are his dependents. Both his parents are, and remember guys, for medical tax credits, the taxpayer can claim for payments towards himself or his dependents. And the dependent, we said, is a spouse, a child, a family member who's dependent for care and support on the taxpayer, like the elderly parents are in this case, or any other person deemed to be a dependent of the taxpayer in terms of a medical aid, right? Or by a medical aid. Both his parents are over the age of 75, and even though they belong to a medical aid fund, they are on a hospital plan which covers only expenses related to hospitalization. But what you might want also want to remember is that point B is based on this one. So we tell you that they belong to a medical aid fund, and which only covers a hospital plan, right? Or expenses related to hospitalization, meaning when they are admitted at hospital. In a hospital. Because of this, he often has to pay for their out of hospital medical expenses. Now this is very important, and this is why it's very important to be calm when you're reading a paper to essentially understand what's happening. This is the way these sentences are structured. It's tricky. You might reach a wrong conclusion where you say, oh, he contributed on their medical aid as well, but the question doesn't say that. It says that the parents have their own medical aid, which is paid. Remember here, that's why it's important to read your required. We tell you that his father is retired and his former employer still makes the contributions. So the medical aid his father or his elderly parents are in is paid by his father's former employer, right? But this medical aid only covers expenses related to hospitalization, right? Only covers. So out of that, he has to pay. Remember, you must pay for medical tax credits. It's not enough to just in care. You must pay. He has to pay. He only pays for out of hospital expenses. That's what he only pays for, out of hospital expenses. In recent years, his father became blind as a result. This further increased the medical expenses that Vukile has to pay. During the current year of assessment, he paid qualifying medical expenses. So another thing you would want to argue with there, we tell you these are qualifying medical expenses. So meaning don't argue, just plug and play with the amount, it's qualifying medical expenses of 15,000 rands for his parents. He also paid for the following medical expenses for his wife and son. Again, key thing here is wife and son. If he paid for his brother who's not dependent on him for care and support, then that expenditure would not qualify even if it was prescribed medicine. Why? Because it's not paid for a dependent, but the wife, spouse, son, child are his dependents. Therefore, this has the potential of qualifying or meeting the definition of qualifying medical expenses. So in this case, we tell you 200 rands paid for non-prescription medication. Non-prescription medication for his son. It's not qualifying medical expenditure. Why? Because it's not prescribed medicine. 700 rands again paid. Keyword paid, not just incurred. For his wife, depending on his consulting fees, medical services rendered to a gynecologist, qualifying or recognized medical practitioner. As his medical aid did not pay, so medical aid did not pay. So that means now this meets the definition of qualifying medical expenses. It's paid for a dependent, for services rendered by a medical practitioner, and the medical aid. These costs were not covered by Vukile or his spouse, so it's qualifying medical expenses. But for now, you park this. Why? Because you only deal with it once you've calculated it. Once you've done, you've determined your taxable income, your normal taxes by the tables, and your primary rebate, and then you come and do 6KP and 6KP. Vukile belongs to a pension fund. Okay, now remember, now pension fund, think retirement. Now I want to know, did he contribute? If he contributes, then it means you need the remuneration column. During the current year, he contributed 60,000 rand. So we tell you now he contributed, then you know, okay, damn, I need remuneration. Need to do the remuneration column. M-Equip also contributed. Then you see M-Equip also contributed. Then you know that's a fringe benefit. 30,000 rands on his behalf. In the 2022 year of assessment, he was unable to claim. So he was unable to claim the 3,800 rands. Then you know, okay, we will include that as part of his contributions. For now, you park this as well. Why do you park it? Because you do the retirement fund contributions deduction second last. Meaning before you you calculate your deduction for donations to PPOs, you must first do the retirement fund contributions deduction. So you park it for now, but at least you should be aware now that there's something you should do. The contribution by the employer is a fringe benefit. Include that 30,000 rands, and then since he contributed towards retirement, then you know you need to include, calculate essentially his remuneration column. The salary, yes, that's remuneration. Commission, yes, that's remuneration. Why? Because it's monies as a result. Money is received by the taxpayer as a result of an employer-employee relationship. The rental income, no, he gets the rent because his tenant paid him, not his employer. Right? 37, yes, his employer paid for his medical aid, therefore that's a fringe benefit. Same goes for the pension, that's also a fringe benefit from his employer, meaning it must be included into remuneration. And that's the only time you need this column right here, when the taxpayer made contributions towards retirement. Right. Yeah, but in terms of the bigger, you park this question, you park it, because you'll deal with it second last before you determine your taxable income. Let me tell you here that Vukile owns 4 Kruger rands, coins made mainly of gold. Then you know, okay, now since these are coins made mainly of gold, then they trigger CGT. During the year of assessment, he sold 2 of these coins. He correctly calculated the capital gain. Another important point here, the capital gain from the disposal is 50,500 rands. Okay, remember he's made in community of property, and when we told you that, well, in this case we are quiet, we are silent about whether or not these Kruger rands are within or outside the joint estate. So if we are not explicit and tell you they are outside, we don't tell you they are outside, then you should always assume that it's a disposal of an asset within the joint estate, meaning for CGT they must account for it 50% or half. But in this case, since we say to you he correctly calculated it, meaning each spouse is supposed to show on their return what they sold. So they are supposed to show their own proceeds, their own base costs, and their own cap gain or capital loss, right? So to say he correctly calculated for himself, may assume that, okay, this is already 50%. But if you say, okay, no, he calculated it in this 50,500 rands, and you assume, okay, that's the 100% and divide by 2, we wouldn't punish you for that. But the main thing here you must also watch out for is this: we give you the capital gain. So meaning this is before your exclusions and your rollovers. This is before your annual exclusion of 40,000 rands for a natural person. This is before your assessed capital loss, right, to get to your net capital gain. And this is definitely before the inclusion rate of 40% for natural persons. So be careful. If we said taxable capital gain, you would take this amount and just put it there in the normal tax framework. But now we say it's capital gain, so meaning you must first go through the whole thing. Is it excluded, or should we roll it over? If it was sold to his spouse, so if we sold the coins to his spouse, we would roll it over, because so disposal by spouses married in community of property where asset falls within the joint estate, and it's not a personal use asset. If it was a personal use asset, you would exclude it from CGT. And then since that means then you now say, okay, it's not excluded, I must apply my annual exclusion, and then thereafter, is there any assessed capital loss from the previous year? If there is none, you deduct 0, and then you move forward and you say, okay, what's now, if there's a positive amount left, what's there? You multiply by the inclusion rate and include the taxable capital gain in the normal tax framework. If, for example, it was you divided it by 2, so it was 25,250 rands, you would then reduce the capital loss to 0, right? So by your annual exclusion, and then you'd stop right there. Essentially, you deduct your assessed capital loss from the previous year, but in this case it's 0. So you'd just be at nil position, because remember your annual exclusion, if you're sitting with a loss, your annual exclusion reduces that loss to 0. If you're sitting with a gain, your annual exclusion reduces that gain to 0, right? So it cuts both ways. Yeah, it's very weird, but it cuts both ways. But in this case, you don't know, because remember, your CGT is the last 3 items you deal with. First is CGT, then you do retirement fund contributions deduction, and then you do donations tax, or donations to PBO. Right, so you park it for now, because you don't know if you still have line items that need to be included above. Then you read, okay, if we really donated 50,000 rands to the Distressed Children Center, this is securing the 2023 year of assessment, so in the current year, which means it is relevant, as I felt compelled to support the Feed a Child movement. This is a registered public benefit organization. Okay, if it gets a certain Section 18 KPA certificate, then you'd have to do a deduction for this. In this case, which he does, because I tell you he received a Section 18 KPA certificate. So that means now, okay, you are free to deduct the 50,000 rands, right? But remember, he's married in community of property, so spouses married in community of property are deemed to donate half of the property each if they donate an asset within the joint estate. Then lastly, we tell you, but again, this is the last item, so you park it. Then we tell you about employees tax of 42,000 rands was deducted by M-Equip during the 2023 of assessment. Then now you know, okay, now you are done essentially. Then you go back and you ask yourself, okay, what can I account for now? Then you know, okay, you're done with this, you're done with that, you're done with this, you're not done with this, but this should come after your normal tax, your primary rebates essentially. And this also is rated to 6KB, so you don't do that. Then for the pension fund, you're like, okay, no, you can do it now, but then there's a CGT, so I need to account for the CGT, because remember I said your last 3 items is taxable capital gain, retirement fund contributions deduction, and donations to PBO deduction, right? So in this case, obviously we're coming here for the taxable capital gain, but before you do that, you want to know what is your taxable income before capital gains tax, and you quickly calculate that. So 54. just copy it there. So this is our taxable income before capital gains tax, and then we calculate our taxable capital gain. Then in this case it's the 50,500 rands. You can divide it by 2 if you think it's 100%, or you can just, if you know, since they say it's correctly calculated, just deduct 40,000 rands therefrom, and then you multiply the answer by the inclusion rate. I'll just do it this way. You multiply the answer by the inclusion rate of 40%, and that will be your taxable capital gain. Of 4,200 rands, and then you want to again calculate your taxable income. Okay, you want to calculate your taxable income after CGT. Right. Okay, I don't know what happened there. Which is now 434,285, and then now you are done with this transaction. Then you come and do the last one, or the second last one, which is the contributions towards retirement. Again, guys, for your 11F, for section 11F deduction, you want to know, okay, what are the total, easy marks first, always. What are the total, what is his total contribution? And then in this case, we tell you that his total contribution is the 60,000 he paid himself. Maybe let me just do it that way. 60,000 he paid himself, plus the 30,000 paid by M-Equip, plus the 3,800 rands he could not deduct from the previous year. So these add up to what? And 3,800 rands, right? So that's his total contributions. Then you say, okay, this is limited, the deduction is limited to lesser of 1 is 350,000 rands, 2 is 27.5, okay, 27.5% of higher between his remuneration, and his remuneration is 451,000, and his taxable, well, you can just copy that, his taxable income, well, this is after, because we've already accounted for the CGT, it's taxable income after CGT. So copy that. Yeah. His taxable income after CGT, and now that is 434,285, and then obviously the higher between the two is the 451, so we multiply that by 27.5%, and you get an answer of 124,200 and 124,025 rands. Okay, and then your taxable income before CGT. Well, how much is that? It's 430,085 rands. So 430 and 85. Right. And then you say, okay, it's limited to the lesser of these three amounts. One is this one, and 2 is 124,025 rands. 3 is taxable income before CGT of 430,085 rands. Then obviously the lesser is 124,025 rands. But then our contributions, remember, I always compare it to our contributions. Our contributions are less than that amount, right? So meaning we're not limited as to how much you can deduct. You can deduct the full contributions this year, and you do just that, and that's it, guys. 11F is really, it really rewards you if you know it. And then now you need, this is now where it becomes important. This is why you need to also structure your answer so that you can use the correct totals. Now you need to calculate the total for before donation, right? The taxable income before the donation. And the taxable income before donation is your, well, you don't need to keep on recalculating remuneration because you only need the taxable income, right? So that is now 340,485 rands. Then we made a donation which qualifies because it's made to a PBO, and it's made to a PBO, that's why, and we got the 18k pay certificate. So in that case, it is we made a donation of 50,000 rands. But then remember, our taxpayer is married in community of property, so he actually donated 25,000 rands, right? However, this donation of 25,000 is limited to 10% of the taxable income before the donation, right? So it's limited to 10% of that, which is 34,048, well, 34,049 rands. So in this case, again, this qualifies to be deducted, right, because it doesn't breach the limit. And then once you are here, you simply calculate your taxable income, but then we must be careful. It's only these two amounts, right? It's 315,485 rands, and maybe you might want to make it cute at this point, right? And then we can now calculate your normal tax as per the tables, right? And then that would be so we have a taxable income of how much? Of 315,485 rands. Then you ask yourself, where does 315,485 fall? 315,485 falls right there. So it's 4680 plus 26% of the difference between our taxable income and 226,000 rands. Right, that's our normal tax. So it's 4680 plus 26%, is it? 26% of the difference, 26% of difference between 315,485 minus 226,000, right? Okay, maybe I should do this. Doing that. There's a problem with this formula. I'm not trying to type formula, blah blah. Oh, wait. No, it's fine. Wait, let me just do it from scratch. So 4680 plus 26% of that minus 226,000. Still, okay, wow, this is exposing me now. I wonder what the issue is. Oh, yeah, the Excel, guys. So it's 63,946, right? And then that's your normal taxes for the tables. Then now, remember, you must remember your age. He's 38 years old. Yeah, let's quickly wrap it up, guys, for your sake as well. He's 38 years old, so he's younger than 65, meaning he only gets the primary rebate of 16,425 rands. Then for now, your medical tax credits. He contributed to a medical aid. Therefore he triggered 6 A, and he contributed for himself plus his wife plus his son. and he contributed for the whole year of assessment, so times 12, right? Okay, I don't know what happened there. Oh, start. Right, that's your 6 cap A. And then your 6 cap B. Remember, once you've done 6 cap A, you need to do 6 cap B. Your 6 cap B deduction, you ask yourself there again, what were his total contributions? And then we tell you here that his total contributions were, let's see, his total contributions were, so you are done, well, you are almost done, 37,000, and his employer also contributed 37,000. So then you are officially done here. So his total contributions were 37,000 by him, and his employer said was 74,000. Why are we calculating this? Because I want to know, okay, out of the total contributions he made, out of the 74,000 he made towards this medical aid, he could only claim 11,136 rands in terms of his medical aid, right? In terms of his medical aid contributions. He contributed 74,000, but he could only claim 11,136 in terms of, as a result of the application of Section 6 Cap A. Now I want to know, okay, out of his contributions, is there any excess he can claim? And they say excess for, then now this is where, okay, you need to determine essentially where you fall in 6 Cap B. Are you in the 33.3 category or in the 25% category? Our taxpayer is 38 years old, so he's around 65. So we do not meet the at least 65 years old requirement for the 33.3 category. Then you ask yourself, the second question is Vukile, or the taxpayer, is it disabled? Nothing in this question. Don't invent disabilities, guys. Nothing in this question just because you only know the 33.3% method. Don't invent disabilities. Nothing in this question tells you that he's disabled. In fact, the only thing we trick you here is that the father became blind, meaning the father became disabled. But then the requirements are that only the taxpayer or his spouse or his child should suffer from a disability. In this case, the wife is fine, the son is fine, even the taxpayer is fine. Only the fine meaning like not disabled. Not to mean like people who are disabled are not fine, right? The taxpayer is not disabled, the wife is not disabled, the son is not disabled, so only the father is disabled. So meaning this is here to trick you, right? So meaning he doesn't fall under the 33.3% method, he falls under the other method. So if that's the case, you quickly say, okay, then I need to deduct 4 times my 6 Cap A credit. So you say, okay, this is equal to, and then we call this next number the excess, meaning the portion of his contributions that he can claim above the 11,136 that he has already claimed. So he qualifies for an extra claim, but a certain percentage, a quarter of this would qualify, right? And then to this you add qualifying medical expenses, and we told you that your qualifying medical expenses 15,000 qualifies. We've told you that, right? Take it as it is, plug it and play with it. But he also made incurred other medical expenses, paid. Remember, he paid for his 2 of his dependents, his wife and son. The 200 rands was for non-prescription or prescribed medication, so therefore it doesn't qualify. But the 700 was for medical services rendered by a medical practitioner, and he paid it and he did not recover it from the medical aid, therefore it qualifies, right? So add the 700, right? Then at this point, maybe I would advise you to just have a mini total here, maybe make that number to know it's a total, right? And this one as well, to know it's a total. Then from this you deduct, since you are in the other, you deduct 7.5% of his taxable income, and then that would be minus 7.5% times the taxable income of 315, right? That's minus 23,661, right? That's giving you 21,494. Right, and then maybe. Then now his 6KB would essentially be 25% of that. So his 12KB will be 25% of 21,495, right? That's his 6KB tax credit. And then, but it's evident in this case, but another thing I would advise you to do is to calculate the normal tax for the year. This is necessary because you want to make sure that your rebates and tax credit did not create a tax refund. But another easy way to test it is when your normal tax payable or receivable is more than, it's a negative amount, that's one, and it's more than the employee's tax that he paid, then you know there's something wrong, something weird. How can you pay SARS or give SARS 42,000 and get back 50,000? Doesn't work that way. SARS, you only get back what you've initially paid them. You gave them 42,000 of employee's tax, and his limit, he can get up to the 42,000. In this case, our normal tax, right? Our normal tax for the year, or his normal tax obligation for the year is 31,011 rands. But in terms of employees' tax, he paid SARS 42,000 rands, right? But he was only supposed to pay them 31,011 rands. Just want to make sure I got the correct amount. So we're done with you, left with this one, 42,000, right? Meaning now his obligation for the year is 31,011 rands. However, he already gave us 42,000, meaning now he must get back the difference because he paid over and above what he owed, right? He must get back the difference as a refund. So now this would be net normal tax receivable by Vukile, and that is 10,989 rands. Now guys, I'm quickly gonna upload this stuff on YouTube, and sorry for the delay, but I don't know, but I think it was my fault, honestly. I just forget to check if the mic was working while I was recording. But yesterday was hectic with all the interviews and all this kind of stuff, so that's it, guys. That's it. And if you have any questions, come consult, and all the best with your preparations for test 4. Hopefully I've clarified a few things that were a headache to you. We don't have any exempt income. That's about it, guys. All the best. Enjoy your studying.